Welcome to today's Explainer. Look, if you've been watching the markets lately, you are probably feeling a serious case of whiplash. I mean, prices are bouncing, then they're immediately dumping, and the headlines are just completely all over the place. But beneath that surface-level panic, there's a really fascinating kind of hidden story playing out in the data. So today, we are decoding crypto's Q3 bounce to figure out where the smart money is actually hiding. Are we seeing a genuine recovery here? Or is this just a fragile house of cards built entirely on leverage? Let's pull back the curtain and find out.
Okay, so to understand where we're going, we first have to acknowledge where retail sentiment is sitting right now. 11 out of 100 on the Crypto Fear and Greed Index. Guys, this is textbook extreme fear. For the everyday trader, there is quite literally blood in the streets right now. The vibe is just overwhelmingly negative, and that diamond hand conviction that drove the markets earlier this year, yeah, it's completely evaporated.
And honestly, it's really not hard to see why they're so terrified. Just look at how the major crypto assets closed out the second quarter. It was an absolute bloodbath. You've got Bitcoin down 14%, Solana taking a 9.4% hit, and Ethereum took the absolute brunt of the damage, closing Q2 down a staggering 26.6%. This is exactly the kind of market carnage that brutally shakes out the tourists and really tests the resolve of even the most hardened believers.
All right. Moving into Section 1, Retail Capitulation versus Institutional Accumulation.
Now this brings us to the central paradox we're looking at today. Everyday retail investors are basically running for the exits, but the big institutional players, they are quietly bidding the dip. Across June, we saw a massive $4.51 billion in net withdrawals from spot Bitcoin ETFs. That is the worst monthly performance since they launched. Total retail capitulation. But, and this is a big but, look under the hood at the cumulative volume delta for both spot and futures. We actually see $681 million in net buying during that early July dip. The institutions aren't fleeing at all. They are aggressively accumulating right in the middle of all this panic.
If you want to know exactly why retail is capitulating so hard, just listen to this quote from GSR's Frank Chaparro. He points out that the average investor in BlackRock's IBIT is now down roughly 40% after sitting on a 30% gain just months ago. I mean, think about that swing for a second. That is pure psychological pain, and it perfectly explains why everyday retail investors are feeling the burn and abandoning ship en masse.
Which leads us to Section 2, the great capital rotation into AI and tech.
So you might be wondering, if everyday retail capital is fleeing crypto in droves, where is it actually going? Well, it definitely isn't going under the mattress. We are witnessing a massive capital rotation right now, and that liquidity is being sucked up by a giant vacuum. Citing data from Meltem D. Marors, AI stocks now make up a jaw-dropping 47% of the S&P 500. Nearly half of the SPY is literally just AI. Tech is basically acting like a black hole for global liquidity, ripping investment dollars directly away from digital assets.
Demirs really put it bluntly here. Roughly 100 tech firms and a few energy tickers generated $6.2 trillion in value this year, while the other 400 companies literally erased $1 trillion in market cap. As she says, everything is computer. Traditional capital is just ruthlessly rotating into tech hardware, microchips, and the energy needed to power them, completely leaving crypto out in the cold.
But hey, don't get it twisted. That doesn't mean Wall Street has abandoned the blockchain altogether. While they might be passing on your favorite altcoins right now, they are aggressively expanding into tokenized real-world assets, or RWAs. The represented asset value in this sector has absolutely exploded to $428.78 billion. So institutions are just sourcing yield from assets with better fundamentals and a lower risk premium than traditional crypto tokens.
All right, Section 3, the under-the-hood mechanics of futures and leverage. To truly understand this recent market bounce, especially after Bitcoin briefly lost that crucial 60K level, we really have to look at the mechanical forces propping it up. And to do that, let's quickly define open interest. It's simply the total number of outstanding derivative contracts that haven't been settled yet. Now, why does this matter to us? Because rising open interest alongside rising prices is the absolute ultimate fingerprint of traders using leverage to push the market around.
And right now, that fingerprint is glaringly obvious. Midweek data showed Bitcoin's aggregate futures open interest rising 4% to top $20.86 billion. But here's the kicker, guys. Funding rates are running hot at 0.228. This means institutional players are aggressively crowding the long side, and they are willing to pay a steeply expensive premium just to stay leveraged in this market.
But remember, leverage is a double-edged sword. GSR asset manager Andy Bear described the massive pre-October 2025 market correction as a forest fire that scared away a huge amount of leverage. And you know what? He's totally right. Despite the recent buying we just looked at, aggregate open interest is actually still down 45% from its peak. The system is recovering, sure, but the scars from that deleveraging forest fire are keeping a lot of traders extremely cautious.
Section 4. Ethereum, the quiet mover.
While all eyes have been on Bitcoin's struggle, we really need to shift our focus to the hidden star of the week. Look at this massive data disconnect. Over a 7-day period, Ethereum saw roughly $40 million in net spot buying. But the net futures delta? A staggering positive $1.64 billion. This completely exposes what's actually going on. Ethereum's quiet rally isn't being driven by people buying the actual asset. It's almost entirely a product of aggressive institutional futures leverage.
Need more proof? Just look at the open interest. Over the last week, Ethereum's open interest surged by nearly 15%, jumping from $9.53 billion to over $11 billion. That is a giant neon sign flashing, leveraged accumulation. Traders are piling in, heavily betting on ETH's upside using borrowed money.
But I have to warn you, this setup is incredibly fragile. We're calling this the ETH leverage trap. High funding rates demand constant buy-side flow just to maintain these positions. With open interest so heavily skewed long, if the funding pulls back to a median range, the price absolutely must hold that $1,700 support level, or we could see a brutal cascading liquidation event. It is a highly precarious balancing act.
Which brings us to our final section. Section 5. The macro road ahead and tipping the scales.
Now let's look at the broader environment. Because in a market held up by fragile, leveraged scaffolding, a single macro event can either save the day or violently snap the entire setup. Traders are basically on pins and needles right now, watching these macro tripwires. First, we've got the July 8th FOMC minutes. But more importantly, the market is closely watching Federal Reserve Chair Kevin Warsh. Warsh has introduced new policy task forces and effectively thrown out the whole concept of forward guidance. This hawkish tilt has injected a massive dose of uncertainty into the market, keeping everyone incredibly defensive.
However, it's not all doom and gloom out there. If we look at historical seasonality, July actually offers a massive glimmer of bullish hope. Looking at data from 2013 to 2025, July traditionally brings a solid 7.51% average return for Bitcoin. So historically speaking, Q3 actually tends to start on a surprisingly strong note.
And right on cue, we are seeing breaking data that hints at a potential vibe shift. On July 2nd and 3rd, spot Bitcoin ETFs saw a $220 million inflow. This is huge because it just snapped a brutal 10-day streak of relentless outflows. The selling pressure from retail might finally be exhausting itself here.
Which leaves us with the ultimate question to wrap up this explainer. The institutions have built this massive, highly leveraged scaffold underneath the market, while retail basically ran for the hills. But can this futures-driven setup actually hold the line? Will everyday retail buyers finally return to provide the actual spot volume we need, or will a macro shot cause all this institutional leverage to violently snap? Keep a close eye on the data, guys, because these next few weeks are going to be absolutely critical. Thanks for joining me on this deep dive.